Felix Zulauf, president of Zulauf Consulting. It is such a treat to welcome you back on the show and great to see you as always. We love having this annual tradition with you. Thanks so much for joining me today, Felix.
Thank you, Julia. Thank you very much for inviting me and having me back.
Well, we love having you on, and I know you usually give like one interview a year, and we're just thrilled to be, part of that cohort that gets to have you on the channel. And I got to say, my audience loves hearing from you. And gosh, I feel like in the last 12 months, Felix, so much has transpired on so many different levels from the macro environment, geopolitics. There's so much to dive into. So let's kind of start where we always start, and that is more of that big picture, that macro picture, that framework in which you're looking at the world, where we are in the, global economy. We can throw markets in there. And as you know, Felix, one of the things about this show is you can take all the time you need to set the table when it comes to that macro picture.
Well, okay, first of all, the world is in a transition from the old geopolitical world order to a new one. First we had the bipolar order. Then we had the unipolar US-centric order for the last 30 years. And that is sort of falling apart or decaying slowly as China and some others are not happy with it and are pushing for a change. So that's the big transition. That creates all sorts of problems and problem spots in the world. And it leads to confrontations that are in parts of the world military confrontations and proxy wars and things like that. And so far, the market has not taken notice of all of that. But it will, because what we see as an underlying theme is rising nationalism. Every nation is beginning to look at their supply chains, and they want to friendshore or de-risk or deglobalize or whatever you call it. It's all making their own economy less vulnerable and more self-sufficient, or their region, if possible. And that creates all sorts of problems for the corporate world, and it will eventually influence capital flows. Because so far, capital from all over the world has flown into the US. The US was the magnet because everybody thought, well, in this sort of fragile world, we want to be where it's safest for the capitalist, for the owner of capital. And that is the US. And that has helped the US markets. It also has helped keeping US interest rates down, etc. And it has, of course, sucked up capital from other parts of the world. And I guess we are coming to the point where these other parts of the world are not very happy about the outflow of capital. So I think we have to think about eventually that capital flow restrictions will come on, or dirigistic measures. Currency controls will eventually follow. I think we will see all that during the late 2020s in this decade. I'm not sure it's in 25, but we have to be prepared in case it begins in 25. And on the economic side, we see that the different blocks are in very different conditions. China is trapped in a deflationary a slowdown condition that is structural in nature, not cyclical, but structural in nature. They have over 100 million empty homes. They have a lot of non-performing loans, much more than what is registered as the official number. They have vastly undercapitalized banks, and they need to recapitalize the bank. And out of such a situation, you cannot expect them to go and come on with another stimulation effort to invest, et cetera, et cetera. That is not going to work. And that's why what they are doing is they are trying to live through that by lending support whenever support is needed. So it's sort of a long-term process, very similar to what we saw in Japan. But out of that doesn't come any growth for the rest of the world. They are major exporters and they import less than they export. So this is a contractory impulse to the world economy.
Mm.
Then you have Europe, and China, of course, is the center of the Asian continent. And as China goes, so goes Asia in a way. Because if China slows down, it takes down with it all the subcontractors. The one exception is India, that is very a closed economy, so to speak, and is far back in the developing stage and is developing slowly and at high growth rates. But that has no real effect on the world economy. Then we come to Europe. In Europe, the center of the European economy is the German economy. It's the biggest economy, and the German economy is in a structural malaise brought on not just by this government but also by the previous government. Germany has done virtually everything wrong over the last 10 years. When they entered the European Union, the euro, they had a unit labor cost that was 30% below the average European Union. And they were extremely competitive. Now they are 6% above the average. So they are not competitive anymore. They have taken the sanctions of the US towards Russia, and they have sanctioned Russia, and Russia has sanctioned Germany, and their energy prices have gone up dramatically. That's one problem. Energy is the core of every economic activity. If energy prices go up, you become less competitive, and if your energy prices go up more than the other guy's energy prices, you lose competitiveness. That is what happened to Germany, and it happened to several other nations in Europe. Then you have the Green Deal. When the Germans try to do something, they usually do it full speed. And the Green Deal was done in extremis. They turned off their nuclear power plants and things like that. So energy prices became ridiculously high, etc. And that was a problem. Then comes the European Union. And the European Union is an institutional misconstruction because it tries to make everybody equal, which is a Marxist idea and not the capitalist idea. And it weakens the strongest, and it doesn't improve the situation of the weaker ones, really. That's what you see. They are the world champions in regulation. And they introduced the regulation of much lower emission standards for the car industry, and that killed the German car industry. Mm-hmm. And so they are shooting themselves in the foot in Europe, so to speak. The German car manufacturers by far have the best combustion engines in the world, no question about that. But, the emission standards applied by the EU really dictate that they should sell less combustion engine cars and more EVs. And in EVs, they are not competitive. They are beautiful cars, electric vehicles, but they compete to cheap cars coming out of China. Mm-hmm. And I have driven at the beginning of this year. I was in New Zealand and I drove the little Porsche SUV, the Macan or Macan, or how you call it, which is the lower version or the smaller version of the Cayenne. And I tell you, this BYD Chinese car was at least as good as the Porsche, but it cost only 25% of the Porsche. 25%. There is no way Europe can be competitive in EVs against the Chinese. So even if we apply 100% tariffs, we cannot compete. So this is a structural malaise. And what the Europeans need to do is they need to get back to good terms with Russia to get cheaper energy, which is politically impossible at the present time, it seems. I hope it will change once President Trump is in the White House. And the EU should become the world champion in deregulation, which I will probably not ever see in my lifetime, you see. But that's what they should do. And as long as they don't do that, they go down the structural slope of hope and continue to lose competitiveness. And I think Europe is in a multi-year sort of stagnation recession. And that's the situation there. So we have China, Asia, that is a problem child. We have Europe, that is a problem child. And then we have the US. And the US is very different. The US has a unique feature in this current cycle that is new, that we have never seen before, which is that labor demand has gone above labor supply. So that means supply is below demand. And that means that the employment situation is remaining strong for much longer than in any previous cycle. I think it has to do with the pandemic situation when many left for early retirement, etc., and they had enough and probably were financially well off and could leave the workforce. And that's a structural issue also. So we have to wait until labor supply falls below, or demand falls below labor supply. And as long as that is not the case, the US economy continues to do very well. And all the conventional indicators pointing to a slowing economy and recession, etc., have not been working for that particular reason. And of course, we see now some deterioration in the employment situation, but we are still far from the point where the two lines cross. And it could cross in 25, but it's onshore. And when we look into 25, where are the potential risks and opportunities in the economy? You know, the opportunity obviously is that we are in a rate cutting cycle virtually everywhere except Japan, but all the other major industrialized countries are in rate cutting mode, despite whatever the inflation rate is. And then we have two important open questions. One is what Elon Musk and Vivek Ramaswamy, what they can achieve in cuts of the budget in government expenditures. You know, they said they would cut out 2 trillion, which I think is unrealistic. But even if they do half of that, that would be 3.5% of GDP. So what would be great long term would hurt short term. And even if they do not 1 trillion, even if they achieve only 1/4 of what they said, 500 billion, it would still be close to 2% that we lose in GDP growth. Of course, it would not be high quality growth because it was probably a waste before, but it would nevertheless weaken the economy because one guy's expenditures is the other guy's income. And then the other critical point is the tariffs. You know, so far the market is pretty relaxed and thinks, well, the tariffs is a bargaining tool that Trump is using to get what he wants, etc. I'm not so sure. I think the Chinese will not bend so quickly, and neither will the Europeans. And therefore, I think we could see the tariffs put on and lasting longer than the optimists believe at the present time. So we are really dealing with some open questions here. What will happen in trade? If the trade tariffs are brought on, as Trump suggested, 10% for all nations and 60% for China, that would mean we are back into the tariffs that we have had from 1900 to 1945. 45, end of World War II. If he does only half of what he said, we are in the period that we had from beginning of World War One to end of World War II. Those were not pretty years, and not only because of the wars, but because of the Great Depression we had, and economic crisis, world economic crisis, and I think tariffs are a tax. And if you introduce tariffs, the other guy is not just sitting there and and saying, "Oh, too bad." He will introduce tariffs as well. So if we go into such a situation with protectionism, that will be very bad for the world economy. And that's probably the problem for 25, that we all of a sudden could have surprising weak economic activity, because if you do not know what's going to happen, because all is up in the air, then you hold back with your investments, and you may hold back with your spending, and you may save a little bit more, etc. So I think these are important factors that we should keep in mind. My guess is that the surprises will rather be to the downside than the upside in terms of economic growth. And the rosy forecast that we see for the world economy, that is close to 3% in real GDP terms, is, in my view, very optimistic, and I think we will undershoot. So that's the fundamental setup. And you tell me what it means for markets.
Yeah. Well, we covered a lot of ground there, and there's so many threads I would love to pull on. Let's hone in on the US for a second. Most of our viewers are US based, and the markets. And I noticed in your investment commentary, Sailing in Dangerous Waters, you talked about the US stock market being in a bubble. I would love to explore that and kind of these the signposts that you're seeing that reinforce that we are in a bubble, and what's next? Is this bubble going to continue to grow? At some point, I suppose it has to burst, but would love to explore that part of the thesis with you.
Yeah, well, yes, when you look at valuation, the different yardsticks you use, and you can debate whether it's the most expensive market ever or the second most expensive market ever, but it's in very high territory, near par with 2000 or so. In some yardsticks, it's above 2000, in some below, but it's in extreme water in terms of valuation. So that is extreme high valuation. The second is, there is sort of a mentality of this time is different, which you see in all the bubbles. And they say, oh, there is a new technology, artificial intelligence, and this creates the new world for us, etc., etc. There is a strong belief also that a moral hazard will save the day, and the central banks will print money, and the lenders will lend money forever at cheap prices, and the bubble could grow. And there is no valuation anchor. And we see even things that we usually see in Ponzi schemes, and that is primarily in the private markets, in private debt and in private equity. There is a lot of lending going on that is not included in the bank lending statistics that the Fed looks at. And from anecdotal evidence that I have, I would guess that this is a big bubble also in that part of the financial markets, which is a little bit off the radar screen of most investors. So bubbles can, of course, grow bigger. And an extreme can go to a bigger extreme. The driving force of a bubble is liquidity. And to keep a bubble growing, liquidity must grow more and more. If the liquidity growth begins to slow, the bubble will break by itself. And then we look at liquidity, and domestic liquidity in the US. The driving force over the last 2 years was the decline in reverse repurchase agreements of the Fed, which really unlocked, sterilized money in the Fed's balance sheet, and inject it into the financial system. And those were over the last 2 years over $2 trillion. And that was the driving force for the bubble or for the creation of the bubble. And then you have the TGA, the Treasury's general account that is currently at 700 billion. And we have the debt ceiling kicking in early in January, which means that the government will probably finance its outlays by using the general account at the Fed. So we could reduce the general account at the Fed, which is sterilized money outside of the financial system, and as it is spent by the Treasury, it enters the financial system. So that's another liquidity source that could enter the market over the next few months, as long as the debt ceiling is in place. Once the debt ceiling is gone, I think the Treasury will stop spending this money. So we have the liquidity situation that could work for a while longer. There are other liquidity tools, of course, that we look at. Global liquidity, one of the driving force, some call it the carry trade, is the financing by borrowing in yen and investing in the Nasdaq or in the S&P futures, etc. And the yen is the cheapest currency. Dollar yen went from below 80 12 years ago, I believe, to over 160 this year. It is now trading at 154 or something like that. And the purchasing power parity, the value of the yen, is about 88, according to Forex experts. Some call it even 81, but somewhere in the 80s. So it's still far higher for the yen than it would be. And now, you know, Donald Trump, when he receives the Japanese prime minister for a visit or he talks to him on the phone, the issue of the currency comes up. You export too much and your currency is too cheap, etc. And therefore, the Japanese are beginning to work to strengthen their currency. They are the only central bank talking about hiking interest rates in 25. And this is important because borrowing in yen has been such a huge source of global liquidity. Because as a corporate treasurer, even if you build a new plant or whatever, you look at what is the cheapest way to finance it. And when you can borrow in a currency that goes down every day for years and that has interest rates of 1% or below, then you go there. And that's why this was a tremendous source of liquidity. Now, if the Japanese do what they say, and if Donald Trump is successful, and I think he will be in that regard, then I think dollar yen at some point will change. We had from 162, we had a big decline to 140, and now it's jumping back in a correction. I think it's a counter trend move into the upper 150s, and as it rolls over and the yen begins to strengthen and dollar yen goes further down. And it's the same with euro yen or sterling yen or whatever. Then, of course, when you have outstanding debt in yen and the yen goes up every day, the game changes. Then you have to buy yen and sell dollars. And that means you create a deterioration in liquidity. And therefore, I think investors should really watch very carefully what's happening in dollar yen, because it could be a factor that pricks the bubble.
You know what, Felix, the parting thoughts, the last time you were on this channel, before I let you go, I was like, do you have any parting thoughts? You told our audience that they need to be paying attention to the Japanese yen and this dynamic. That is fascinating. So this, what I'm hearing from you, this is like a critical way of it's a critical indicator, if you will, of global liquidity. Is that a fair way to characterize it?
It is because it has been used as liquidity generation on the way down in the yen. it is a liquidity proxy. Dollar yen is a liquidity proxy. And if dollar yen begins to decline, if the dollar begins to decline and the yen goes up and dollar yen ratio goes down, that means that global liquidity is beginning to deteriorate.
And that
And
can, yeah.
and in a bubble, when you are in a bubble and all the valuation excesses you have and liquidity begins to slowly disappear, then one stock after the other begins to fall by the wayside, and eventually the bubble is pricked. And of course, in the bubble, the leading segment in the bubble are the AI stock and the FANG stocks and all those, where the fantasy is about this coming artificial intelligence cycle. Now, in terms of new technology, I think artificial intelligence is going to play a tremendous role for the future. But when you look at all the innovations, be it the internet or whatever, it's usually you have a first investment cycle where all the big players want to be number one or close to number one, to be the early leaders and winners in the game. And then they overdo it. They invest too much, and then the return on their investments is not good enough, and then it slows down. And then they say, oh, it's been a fad. The investors say it's been a fad, and the stocks go down. Amazon, when after the internet bubble pricked, Amazon went down 90%, and it's a great company, and it came roaring back later on. But these internet stocks, some of them are so ridiculously priced that they could easily decline 50, 60, 70% once the bubble burst. I'm not saying that's going to happen tomorrow, but I think 2025 is a candidate year for that. What speaks against that, I must say, is the decennial pattern. There is a so-called decennial pattern when you look at all the decades from early on, when we have data on the stock market, on the U.S. stock market. The worst year is the seventh year, the year 7. The second worst is the year 2, like 22, for instance. The best year by far, beats every other year, is number 5. So next year is the 5th year in the decennial pattern. And therefore, I do not believe we go straight down. I think we go higher during the year, but we go higher probably with a lot of volatility. And we have had most of the 5th years, when they are very powerful, have had 2 not so good years before. And then the 5th year is very good. We have had 2 excellent years in the 2 years before. 23 and 24 were excellent years. Therefore, this 5th year could be an aberration. The only year ending with 5 that had a negative return was 2015. And 2015 was down, I think, 1% or something like that. I'm not saying this is going to be a fantastic year, but it is something that bothers me, with an outlook that at some point in 25 the market will reverse, and it bothers me that 5th years are usually good years. So it's contradictory. But it could be one of those exceptions. So I do not believe that after 2 double-digit years, we have another 3rd year with double-digit returns.
Yeah.
I think the first half or so, or into summer, could be very good. Maybe a shakeout in the first quarter, and then another run-up to higher highs, and that could be it, because by that time, liquidity will most likely begin to dry up.
Well, Felix, you've described it to me as like the decade of roller coasters for the markets. And so it sounds like that's exactly it. We're on that ride still.
I think 25 could be a mini version of the long-term roller coaster that I'm still expecting. So
Hmm.
I think in this decade we go to a high like in 25, we come down sharply, maybe in 26 or 27, and then we go up again because when asset prices go down sharply, then our economies weaken because we are now in the financial asset economy. That means financial markets are driving the economy and not the economy is not driving financial markets. So if asset prices go up, it strengthens the balance sheet of consumers. And when consumers feel wealthier, they spend more and they save less. And it can continue as long as asset prices go up. When asset prices go down sharply, let's say 20% or so, then all of a sudden the balance sheet of the consumer doesn't look as robust anymore and they save more and spend less. And then you have a weaker economy.
Yeah. That also makes me wonder, Felix, so this bifurcation in the economy, not everyone is an asset holder, and those who have been asset holders have benefited quite nicely from these policies in recent years. Curious, like what you think about that. Kind of like maybe the haves and the have-nots, a bit more like inequality, if you will.
That's actually a topic that goes very deep. When you look at the inflation rate, you can break it down into traded goods prices inflation and goods and service inflation that cannot be traded over the border, like real estate or like a haircut or a meal in the restaurant. Okay. And we call it service inflation, but it really also includes real estate.
Mhm.
And and in the basket of the consumer goods that are used to calculate inflation, the CPI, you have a lot more traded goods than service goods. And you consume more of the traded goods than the service goods. And therefore, the CPI that is calculated for us, even if it's probably wrongly calculated anyway, but I think does not reflect the real cost of living that an average consumer experiences. I think it's not the reality. I think it's too low. The actual cost is higher. And the problem with that is if the CPI is computed too low, central banks use that as an indicator to steer monetary policy. And when it's too low, they are too generous. And when they are too generous, they really pump up the service sector and the real estate sector. And real estate prices go up, and the haircut goes up, and the meal in the restaurant goes up, etc. And, the upper 25% of the population may not realize it that much, but the lower 75% and those who rent and do not buy, they realize it. Their costs go up over proportionally and they are getting squeezed. And I think this is one of the reasons why Trump won the election and Biden or Harris lost the election. People are dissatisfied with their economic situation. And I think the US in particular has a serious inflationary problem. I come to the US for 50 years now.
Mhm.
And wherever I went, a comparable meal in a comparable restaurant, Switzerland to the US, and Switzerland is the most expensive country in Europe. Um, the US was always cheaper. Not in the last few years. Since the pandemic, the US is more expensive than Switzerland for the first time in 50 years. And that tells me that you really have a serious inflation problem that is hidden by wrongly computed CPI statistics.
Mhm.
And of course, when the central banks use those statistics, what they do is they pump up the service sector and the real estate sector. And what it leads to is that the average Joe and Jane they cannot afford a home anymore.
No.
They have to rent. And it's the same in Europe, by the way. It's the same. The process works exactly the same. And it's a big problem. And at some point, those two lines, the line for service and real estate and the line for traded goods, which is due to the Chinese that it is down and behaves so well, the two have to come closer together. So the gap has to narrow. And the gap can narrow by either traded goods going up, which is probably the case if we have a trade war with tariffs, then traded goods prices go up. Or service and real estate prices have to come down, which would be an economic calamity. I think we will see that in the next few years, not necessarily in 25. In 25, we may see traded goods prices going up because of tariffs. But I think later on, real estate and service prices will come down once the economy weakens.
Yeah. Okay. So to recap the equity markets part of this conversation, we could see a medium-term peak in the US and global equity markets in Q1, followed by a correction of 10 to 20% in the major indices. I also, Felix, I want to talk about the bond market because your investment commentary was talking about a potential shift in the bond market dynamics, transitioning from a secular decline to a new paradigm. I would love to just explore this and, what are the structural factors that you see driving this change and, how should investors think about it?
Well, bonds have gone through a long cycle with peaks in yields in 1981 and a bottom in 2020. So 10-year US Treasury yields went from 15% to 0.5% in 2020. And I actually wrote a report in 21. I gave a speech to an institution, a crowd, the buy of a generation for bonds and the buy of a generation for stocks. And in 2020, I entitled one of my pieces to my subscribers, The Sell of a Generation for Bonds. And that was at 0.5%, and we are close to 10 times higher now in the yield. We are 4.5, 4.4% or something like that. It's very tricky what we see in the bond market. I think we have seen the first upcycle in a new secular uptrend in yields peaking at 5%. That was in fall of last year. And we have had so far two medium-term declines with the low at about 360 or so. Usually we have up to three medium-term declines. So we could have another decline. But the situation is so tricky because this cycle is manipulated and very distorted since the pandemic. And it is conceivable that we bounce higher first towards 5% and then go down when a recession-like slowdown will hit the US economy. So I think a 5% yield on 10-year treasuries is a buy. And below 3.5% is a sell. And I cannot tell you right now when to do what, but that's the range that I see for next year. I think there will be at one point, one good medium-term run down in yields. And that is going to be a hell of a bond market rally, and it could last a few months. And the return should be fantastic. If you go from 5 to 360 or 350 or so, that would be a hell of a return, and probably within 4 to 6 months, and then it's over. Because if we have an economic calamity or a slowdown or a negative quarter or whatever, I think the authorities will immediately enter the picture and begin to stimulate. Trump is growth-minded. He wants growth. And if growth is not there, he will fabricate it. He will spend money The government will spend money and he will tell the central bank what to do. And if the central bank doesn't want to do what he says, eventually they will. They will. They will listen to him. So I think then you have the next upcycle, the second upcycle in bond yields. That's probably from very late 25 or early 26. And then you go to 5 again. And then we would most likely break through because you create inflation again. And last time inflation was down to zero virtually. And in this cycle, we probably do not even come to 2%, or we stay above 2%. So we have a higher base from where the next inflation cycle starts. And then the inflation will rise into the late 20s and bond yields will go higher. At 5%, I would assume that the Fed will come in and try to prevent bond yields from going higher. And if they do that, it's what they call yield curve control. They control the yield curve that the short end and the long end is sort of flattish and stays that way. If they do it and there is momentum due to stimulus, tax cuts, or what have you, then of course you have a very inflationary monetary policy in place, and that will lead to higher inflation eventually. And higher inflation, at some point, interest rates will go higher, and then you prick a much bigger bubble later in the decade.
And what kind of bubble would that be that you prick?
That bubble would be different because in that bubble there will be a new leadership. It will be commodities and commodity related cyclicals, value stocks that will come on, that have been in the shade of the Magnificent Seven. This cycle, it has been all technology, and that's where the earnings growth is. In the next cycle, I think it's more the commodity sector, the value stocks and the cyclical stocks that are not expensive, that are not so expensive. They are underrepresented in virtually all portfolios. All portfolios are highly concentrated because in today's world, investors buy ETFs, okay? Now, the world market capitalization of world equity markets, 75% is US. So if you buy an index fund for the world market, wherever you are in the world, 75% goes into the US market. In the US, the biggest 10 stocks are probably, 35% or even more of that, or even more, a big number. So you are concentrated in the whole world in a few stocks. And when the bubble bursts and the market turns down, and it will, we do not know when, but it will at some point, then every portfolio in the world is concentrated in the same stocks. And when they need cash and want to reduce their exposure, they all sell the same stocks. So those stocks then go down a lot. And all the other stocks that are underrepresented, underowned, underweight, etc., they do not go that much. And they begin then to develop relative strength. And they go into the next bottom of the cycle with rising relative strengths. And that's when new leadership shows up. And in the new cycle after this one, the next new cycle, that is going to be the new leadership. That's my best guess based on what I see in my analysis.
Yeah, we've had a lot of other guests who've talked about that too, like the rise of passive and the concern with the ETFs. And you might find yourself, you own it multiple times because of the underlying stocks in these funds as well. Okay, I want to go back, Felix, to the US, specifically the US economy and GDP growth, and the two concerns that you mentioned earlier. Let's start with the Trump trade offensive, specifically the tariffs being a really critical point to pay attention to, because you were drawing some parallels, some historic parallels to the potential trade war scenario, kind of what we saw back in the 1930s, leading up to World War II, but the Smoot-Hawley Act. I sense from you that that is a real concern, and maybe thinking about more of the geopolitical backdrop that we're in right now. Can we just flesh that scenario out or that risk? Because I feel like it's something that you're keen to talk about. I want to hear more there.
Well, in 1929, we had an overvalued stock market, and the stock market was technically extended, and it started a medium-term correction. And then in June of 1930, the peak was in October of 29, and in June or 6, 7 months later or so, the Smoot-Hawley Act was introduced, and that was protectionism with tariffs, etc. And that turned a medium-term stock market correction in a complete meltdown and an economic catastrophe. I'm not suggesting it's the same as it was then, because then we had the gold standard, and authorities could not, intervene with monetary policy as they can today, or they didn't understand it, so to speak. Today they would flood the system. If that would happen, they would flood the system immediately, and they would debase the currencies, and it would make real assets go up dramatically. Because when you enter a crisis situation is when your asset prices in the economy begin to fall. And in an economy, you have assets and you have liabilities. Liabilities stay the same, but asset prices go down. Then you create problems because the banks get underwater, etc., etc. Therefore, you have to get the asset prices up again, and you do that by pushing as much liquidity into the system until asset prices rise. Of course, this has some effects. Asset prices come up, but your currency, the value of your currency goes down, of course. And as the value of your currency goes down, expressed in that depreciating currency, real asset prices go up. And that's why I said in the next cycle, it will be real stuff, commodities and things like that. This plays into that. I do not believe we are in the 1930s. I believe we are in a different system. We have no monetary anchor. Our currencies are fiat currencies, paper currencies, but gold would go up, Bitcoin would go up, and dramatically so, dramatically so.
Interesting. So gold and Bitcoin. Interesting. I know you own gold. Do you own any Bitcoin?
No, I don't. I'm probably too old for that. But last time Bitcoin dropped below 20,000, I wrote to all my subscribers, if you ever think about buying Bitcoin, this is the time to do it. So in my analysis, it was clear you had to buy Bitcoins. I didn't. I'm a dinosaur. I have old-fashioned strategies, and I'm not in the game to really, improve my wealth dramatically. I just want to keep what I have and make a little bit more out of it. That's good enough for me. So I'm too old to play those games. Would I be 20 years younger? Sure, I would most likely own some Bitcoin. My son does, so the family owns some.
Yeah.
But in an extreme scenario, that can go a lot higher. Of course, I think Bitcoin, in my analysis, I have another run for the Bitcoin. The best part of the run is behind us. My targets for Bitcoin are between 115 and 130, 100,000 and 15 and to 130 in this current run. And if this current run ends, then I think a big run has ended and we go into one of those big corrections. And one of those big corrections, are usually up to 80%.
Got it. Well, we're just north of 106,000 right now as we are recording this. You mentioned gold. This audience loves gold. Can we hear more of your thoughts on gold?
Well, gold is money. Dollars are not. Dollar is credit. Dollars are credit. Dollars have a liability on the other side, and all the monies that you see, the currencies, uh, those are credits that are not money, so to speak. Money is gold because it does not have a liability. And I mean, it's just because it is rare, it has a nice color. And because it is rare, it has a certain value and always had to mankind. And they digged it out and kept it as a store of value. And gold was always worth about an expensive man's suit. So that's 2,500 or $3,000 at the present time. Not everybody wears those suits, but I said an expensive suit, and that has been true throughout history since men are wearing suits, and it just reflects the debasement of the fiat currencies. I mean, currencies were linked to gold and backed by gold up to 1971. And in 71, the US went off the gold standard. And since then, the currencies have debased dramatically. I mean, the dollar has lost, 97% or so in the last 100 years. And the strongest currency, Swiss franc even lost about 89% or so. Uh, the system keeps going, and the system keeps going until it hits a wall. I'm not sure we are hitting a wall. I think later this decade it will become very ugly because the system may hit a wall because in the last 20 or 30 years, we had the benefit of interest rates coming down. And we could, whenever there was an economic problem, we could throw money at the problem. And we covered the problem, but we didn't solve it. And you can do that as long as money is cheap. Interest rates are low. I think in the next few years, interest rates will go up. As I said, we are in a secular uptrend in interest rates. And as we go higher, interest compound and it becomes expensive. And therefore, we cannot just throw money at it. You see, our governments already are up to their eyeballs in debt. The governments of the industrialized world are up in debt. Most of them are up very high in debt. And you cannot continue as ever because the cost of interest on that debt keeps rising. And we are in welfare states and we are in wars. And those costs continue to go up also with the aging and with the conflict that is on. So therefore, we are coming to a point where we get squeezed and we have to make big decisions. And usually it's Murphy's Law, all the bad things come together. So I think it will be a turmoil period over the next 5 to 8 years or so where we go through those roller coasters that I explained, and where it will be very difficult to keep your head when all the others are losing. That's the difference between boys and men. Boys are losing their head. They are playing hard as long as the sun shines. But when it starts to rain and the crisis hits and prices begin to fall and unravel, then you have to know what to do and you have to be prepared for it. If you are not, you could lose everything and more of what you earned before, because usually in a bull cycle, your average price is not down at the bottom. It is somewhere about 70% into the bull cycle. So your average price is usually too high to afford to sit out the down cycle.
Felix, you are incredible. And that was such an incredible hour spent with you. Felix Zulauf, president of Zulauf Consulting. I just want to say thank you. Thank you so much for your time, sharing all of your knowledge and your wisdom and your insights with this audience. We look forward to having you on every year. And I know you don't give that many interviews, but if you ever want to give an update, you are always, always welcome on this channel. And I just appreciate you. I wish you a happy and healthy holiday season and a new year as well, and a great trading year as well. Thank you so much.
Julia, thank you so much for having me. It's been a pleasure. It will be a pleasure next year again. And to you, the same. Happy holidays and all the best wishes for New Year.
Thank you, Felix.